let's just go through the positions that we have on and the general understanding of how to play this. Because the trends right now are very clear. If you're using any sort of trend following signal, it's a prime time to play this and to bet big and maybe even increase your position sizing. At the core, obviously, is the conflict, not the conflict, but the real war between US and Iran, which is a proxy, essentially, war between US and China. We don't need to listen, honestly, to the talks and tweets and everything that Trump says right now. The overall general assessment and conditions are pretty clear that this has to escalate for the simple reason that there cannot be any sort of reconciliation or talks, because the main point here and the main idea and main desire from both sides is the desire to control the Strait of Hormuz. Iran said that it is sovereign right to control the Strait of Hormuz, and US cannot possibly let that happen. And no sort of peace is possible here, because this is it's just like between Russia and Ukraine. One country wants the complete demolition and to destroy the other party, and the other party wants to survive. So what sort of peace talks can there be? So we have this usual pattern. Obviously, Trump Monday opens, he talks about peace talks, very plausible, we're going to reach something, but they are not. They are building more and more ships, but our positions are built not on the idea that it's going to go nuclear and there's going to be invasion of Iran or anything of that sort. We're just working from what we have on from the flow perspective, and from the understanding that regardless of what happens, Strait of Hormuz remains closed. It is highly, highly, highly unlikely that it's actually going to be opened in any sort of through the peace talks. So until Strait of Hormuz is closed, all of these positions should continue to work. The main trade, obviously, of the closure of the Strait of Hormuz is higher oil, lower repricing higher in rates, especially long end rates. Yes, we have the move lower in the short end rates, but short end rates are irrelevant at this point. We market overpriced significantly the possibility of a rate hike and overreacted to this and thought that the Fed actually is gonna go raise into that. It's highly unlikely. Plus, if Warsh comes into the office, he's not going to be raising rates at all, because so the play here is not to be long of this. You actually want to short this. You actually want to be short of the potential future rate expectation. We are gonna get rate cuts for the simple reason that regardless of inflation, regardless of growth, regardless of unemployment, the debt burden is unsustainable, and they need to get rates at the front end where they are financing right now. Majority of the financing is happening at the short end. They need to get these rates lower, and they will get these rates lower like they did in every single war. And we are currently in World War III. Definitely we are in the heart of it. There's going to be escalation. We're going to go deeper, and during these times there are Federal Reserve cuts rates, reduces the burden on the government, and monetizes the deficit. It's just how that works. It's just how it is. There is no other way around this. So, but you don't really want to play this, or you don't really want to be playing this type of movement, or going like Z 2026 expectation, or like this one, this contract March 2027 expectation of rate cuts. We overpriced this. It's highly unlikely that we're going to go lower than this. Yes, we are going to get inflation report next week, and it's probably going to be ugly, and we're going to get some move lower, but I don't expect this to print sub 96 anymore, essentially. But the point here, yes, you actually want to short this, but not via rates or via ZT futures. You want to be long gold. All this massive reaction that came in from the gold price was in the back, obviously, of the massive repricing of rates. One day you're pricing in essentially certainty of rate cuts. The question is how many, and the other day we're pricing in like 1.5 hikes over the next year, which is, it's not going to happen. This is why gold is the ultimate expression of this. Gold, but it's a different trade. It's the same, the basis upon which this trade is built is the same. The idea is the same, but the expression is rather different, because gold is going to be moving slower. Usually it moves slower. The playbook that we are adopting is the one that we had in 2008. The different reasons entirely, but the same, the move of the same magnitude. The idea is the same. This is what you have: a massive repricing in gold higher. Then as some crisis happens, gold reacts to this until we go back to reality, and they start printing money and monetizing the deficits and all of that. And debasement is not over. We are going to go into the culmination of this. And gold, whatever gold does here, as it did in 2008, massive volatility, incredible high volatility. This volatility will persist. We're gonna consolidate here. Move. I can easily expect and see gold move sub 4,000 on a couple of nasty, horrible CPI prints. Maybe CPI. Maybe that's going to be CPI. This is the same thing that happened in 2022, right here. Peak to trough, minus 22% retracement on the back of potential higher rates, but they're not going to be raising rates as they did in 2022. So this time is going to be rather, from the time perspective, it's going to be smaller, but from the volatility and retracement perspective and moves is going to be bigger. We're going to consolidate, and at some point during this year. Later on this year, we're gonna get a signal to buy this, and it's gonna slowly resume this uptrend as gold does. It's gonna move up, consolidate for a while, and then it's gonna print another 30% plus year, maybe 50, maybe 60, and so on and so forth. That's the main idea. This is a better expression of short this, rather than going like any SOFR or futures contracts for the expectations. But the best trade still remains, up until Strait of Hormuz is closed, still remains this. However you want to play this, either it's higher inflation, this is very much negative for stocks, or much higher oil prices, higher inflation, demand destruction, we're pricing in cuts instead of hikes. It's still the same thing. It's still negative for US 500, for the SPX. This is still the place to be. In the short term, I'm looking at 60. If you look at the SPX, I'm looking at 6,200. It's the playbook is we might get some sort of escalation this week, maybe, I don't know. But the main idea is to play around the inflation report, which is going to be happening on the 10th of April. Any bounce here is a sell. We'll get back to it. Very natural behavior in the long end. Very natural behavior in the 10s and 30s. We overpriced significantly the probability of rate hikes, and 30-year is retracing. We broke trend here. So once again, the first break in trade, which is right now, this is your trade. The first break in trade, you buy into this. So that's what we are probably going to be doing, as we are going to be testing this trade or breaking this trade. This is going to be the buy going into the next week's inflation print. So that's what we are looking at. We are looking at to be buying US 10-year, and we are, shorting TLT essentially. We are very much looking to be shorting TLT. It's either from this high or from this high. Gold once again is to be seen, to be continued. So we consolidating, moving higher, lower, waiting and observing. Oil once again. Until the Strait of Hormuz is closed, and it will most likely, the highest probability outcome is it will be closed in the short term for sure, over the next week, 2-3 weeks. Right now we are seeing rationing of electricity, right now shortages in Africa. This week we are already seeing this in East Asia. This week is going to be exacerbated in East Asia. Next week is going to hit Europe. The idea here and why oil is not at 200 already, or why people are so surprised by that, by the lack of movement in oil prices, lack of upside volatility. We had upside volatility, but it was quelled here artificially, obviously. But what we're gonna get is the comparison I'm gonna make is this concept of the light from the sun takes 8 minutes to reach the earth, and if the sun were to go out right now, we will know that in 8 minutes. The same thing happened with oil. The Strait of Hormuz closed, but all the tankers, all the oil that has already been on tankers in the sea, it continued its flow into the East Asia, Europe, or whatever it meant to be. And now all the tankers are empty, which were on the sea when Hormuz closed. All of this initial dampening mechanisms that they used, SPR, all of that, and it's exhausted itself. These measures largely exhausted itself, and all of the smartest people in this business are saying that yes, at some point during the this next maximum 3 weeks out, we're gonna hit a wall, like serious wall, where there's simply not gonna be enough barrels, and the oil price is gonna do the same thing that it's essentially did here, the repeat of that, and certainly signal supports that type of behavior. Let alone if we're gonna get some sort of escalation, which it looks like it's the only reasonable expectation to have here, is that we are going to get some sort of escalation. US cannot possibly just abandon control of the US of Strait of Hormuz and just give Iran. Therefore, China, let's give up the control to China, the Strait of Hormuz, and give up the control, therefore, of the entire region, of the entire Middle East to China. That's essentially the hegemon is going to say, I give up. Hegemon never did that. It never said that. Throughout history, look, the empires, they're going to fight, and it's going to be most likely futile. The historic pattern says and suggests that it's going to be the last fight of the US. It's going to be horrendous. It's going to be, I have no idea what they want to do there with those 10,000 troops, but the base case and the most probable case is that we're not going to get peace until there's some sort of escalation. So let's see how that plays out. And oil is certainly positive trend, positive trade. Yes, we had these last week on Monday. We had this essentially lie. Trump was lying that talks were initiated and they were going well for the reason that he wanted to job on the price of oil lower. He succeeded in that, but once again for 5 days essentially. Now we're at the same place, and once again, if the Strait of Hormuz remains closed for the next week, 2 weeks, this thing is gonna blow out again. And as it does so, it's highly unlikely that the 2-year is going to be pricing in more hikes, for the simple reason because this is going to become a real demand destruction. When oil spikes to 200, you are not really worried about inflation. You're going to be worried about recession. You're going to be worried about people not afford to buy anything, essentially. It's going to break, the whole supply chain is going to break down. The whole world economy is going to break down. So what's going to happen most likely is we're going to, 2-year yield is going to be pricing in more cuts, but the 30-year yield is going to be pricing in inflation, essentially, and fear of inflation. So yeah, this is most likely going higher, and let alone that it's unlikely, but at the same time, SPX is, if oil actually spikes again significantly, another 30%, I'm not talking about 200, another 30%, SPX is going lower significantly, and not 6,200, but 6,500, 5,50, 800, something like that. So yeah, it's interesting how Federal Reserve is going to react to all of this, because credit is going to die, high yield is going to die if that happens, obviously, but we shall see. But you do want to be long US 30-year, 10-year, once again from these levels. Even if we break the trade here, you still want to be long and buying that. Gold, so far, like, let's see what happens here. Let's oil higher, Dixie higher, which is really nice. Very interesting, right? 2-year yield is pricing less cuts on a day, more cuts on the day, and Dixie is going higher, which most likely will continue. And once again, the other thing, which is of the utmost importance, is look at the Japanese 30-year. Once again, as we've said, Japanese 30-year yield is the same as the US 30-year yield. Once they're starting to have real problems, then which they are already having, you can see that oil hits East Asia first, and the debt here is gonna blow up first. Once again, it's either Fed opens the swap lines, helps to contain this, therefore by devaluing the dollar, or they're taking the money which they collected and they are selling US assets, selling US bonds, US stocks and bonds, and containing the damages with the use of that money. Japanese cannot right now simply cap yields by printing money, because their currency is going to absolutely evaporate. So they're going to be using those trillions of dollars that they saved up in order to do this. It's a temporary solution, and the results of this are going to be diminished over time. But that's what we've seen this. We've already seen this literally a couple of months ago. You've had this, and then US Federal Reserve comes in and helps them to cap yields by devaluing the dollar, because they don't have the choice. There is nothing they can do about this. This hits Asia first. We've seen this. Next is Europe, and European yields are going to march higher, and only then is going to be reflected in the US 30-year. But the main idea with the US 30 and 10-year, it's not the major escalation or oil spike. It's the very interesting how we're going to react to this inflation print on the 10th, which is going to be horrendous most likely. It's going to be bad. So it just makes sense to be positioned short TLT throughout all of this up until the 10th, April 10th. Then you reassess, you look at the print itself. Maybe we're gonna get escalation before that point, before the inflation print. Maybe we're not, but the trend suggests so, trade suggests so, and tail suggests so. So this is what you want to be doing, shorting TLT here. Shorting SPX, we're gonna get to this. I'm not sure you want to be playing oil here, especially into at the top end. No, it made sense to be buying that type of dip, but right now, no. Dixie should be marching higher here continuously. Bitcoin is signaling the same thing as everything else is signaling, but Bitcoin, once again, every asset class moves on its own, maybe meaning it has its own flow dynamics, and you would expect that Bitcoin should naturally drop like 30%, because it's the most riskiest thing. Once this thing begins, the war begins, World War III begins. But once again, it fell 50% already, very much shorted, plus the option dynamics made it rather pinned, and just naturally how that happens. Once you reach a certain point during the downside, as it did in 2022, most of the downside is over, and now it's sort of consolidation with the final capitulation at some point to come. So that's why we're saying that it is still a short. We're looking at 60, looking at 50,000, maybe even lower, but it's not a short. But at the same time, it confirms a negative price action, a negative sentiment, via being negative trade, negative tail, negative trend. So this is still a short. That's nice. Dixie higher. VIX is printing once again. Every single time VIX dropped into the trade, you bought this. This is your trade, you buy this. This is your trade, you buy this. This is your trade, you buy this. And short. As we've said, March 21st passed. The quarterly expiry passed. All that option interest disappeared. All those hedges naturally closed. The closing in position were significant. And so this type of price action, this pinning, this gamma pinning is over, and markets are free to reprice to whatever level they see fit for whatever environment we are in. And the environment right now is absolutely horrendous, absolutely fucking horrible, as it was into 2022 in April of last year. Every single time we had the call that the SPX is short. So yeah, this is lower, but perhaps much lower. The only question is how you play this. Once again, we've been short this since this day. We've opened short call spreads with put spreads on top of those, short long Tesla shorts, different expressions of the equity shorts we have on right now. But I am looking to short this on any sort of bounce. Still, I would like to short this into the 4 hourly. If we get some sort of retracement here, this is definitely a short, however you look at this. So I would add to this if we get a top end on the SPX once again, which is at here, 6,500 is a, we broke not only trend, we broke tail as well. So short this, short everything points to short. Credit points to short, horrendous situation in credit as well. All of the US major world equities point to short, and it is highly likely that we're going to get some sort of puke and escalation once again before this all ends. Or maybe it just doesn't end, because nothing ever happens, yes, and then like once in 100 years something does happen, and like this is it. This looks like this is the big thing. This is it. This is we've been in World War III since 2014. Once China, once Russia annexed Crimea and invaded Ukraine. This is natural culmination, not culmination, but this is natural development of things. We are going into the world. We are in World War III, and now it's picking up the pace. There is no coming back. We're not gonna just suddenly, oh yes, let's all live together in peace. Thank you for your attention to this matter. The next probable scenario is they do invade Iran with whatever, God knows what they're trying to do there, or some sort of escalation. Maybe it's not invasion, maybe it's something else. They've already started bombing infrastructure, electrical infrastructure, water plants, all of that, desalination plants in Iran. China cannot possibly cede the control of the Strait of Hormuz or control of the entire Middle East to the US, because if the US controls the Strait of Hormuz, China is once again very much reliant on that oil. They need to be in control of the Strait of Hormuz, or at least not let US control it. So the next reasonable assumption to make is they're gonna make, if not go straight up war on Taiwan, but maybe, I don't know, hint that they were going to attack Taiwan, or maybe amass some sort of massive armada of ships around Taiwan and say, yeah, we're going in. If you're not leaving Iran, we're gonna go in on Taiwan and something like that. I don't know, but yeah, this looks like a big one. Honestly, there is no way out of this. It looks like no way out of this. Interesting short is Apple. Apple is quite interesting. We are at the tail here. I like these setups at the tail. Broke trend going into the tail, took out the trade, and now once again we are looking for a major downside in the next 2-3 weeks. And Apple looks like it can break this tail and easily go to 220, sub 220 in a heartbeat, essentially like Meta did here. This is your tail, and that's what you get. Amazon, Microsoft, everything is bearish trend, like Apple, Google, for example. This is your trend break this year. This is what you get. Tesla broke tail, most likely going to continue falling. Nvidia, once again, right, the biggest expression of the AI trade. Nvidia, MU, everything broke tail, everything broke trend, everything is short. So Apple is lagging behind all of that. I would not be surprised if we get some sort of retracement from SPX, as I would add into Apple on the short side here. Russell 2000 looks really nice on the short side as well, going down to 230. We shall see how we're gonna play this. Once again, I'm thinking that we are gonna get some sort of reprieve and retracement this week, hopefully, because it will give us an opportunity to add 2 more shorts. I'm looking at minimum 6,200 during the next couple of weeks, but if we're gonna move higher, it will be an opportunity. And same thing in the US 10-year lower. It's an opportunity to buy that, and via shorting TLT. And yeah, this is it until this all is going to persist, until bond market breaks. I would assume so, but we shall see how it's going to play out. That's the two main positions right now: are short equities and long the 30s and 10s in the US, in the Japan, and whatever country pick, whatever poison you have, until this resolves itself. But for now, we don't have a resolution. So let's see how that all plays out.